Hello, I'm a real estate investor. Please tell me why a cash-on-cash return on investment is important when considering the purchase of a property using debt financing.
That's a great question. Understanding cash-on-cash return is absolutely crucial for any real estate investor, especially when you're using financing. Let's break down why it's so important. Cash-on-cash return is a straightforward metric that measures the annual cash income you receive from a property in relation to the actual cash you invested. It's calculated by dividing the annual pre-tax cash flow by your total cash investment, which includes your down payment, closing costs, and any initial repair costs. Here's why it's a must-know metric. It measures the return on your actual capital. Unlike other metrics that look at the property's total value, cash-on-cash return focuses only on the money that came out of your pocket. This shows you exactly how hard your own capital is working for you. It evaluates how well leverage is working. And using debt or leverage can significantly amplify your returns. A strong cash-on-cash return shows that you're using debt effectively to boost your personal profit after all the mortgage payments are made. It highlights your actual cash flow. For investors who need an income from their properties, this metric is a direct indicator of how much spendable cash the investment is generating. This is essential for managing your finances or saving for your next investment. It's a powerful comparison tool. It lets you compare different deals on an apples-to-apples basis. For instance, if you're looking at two properties with different prices and loan structures, the cash-on-cash return helps you see which one will give you a better return on your specific cash investment. Let's use a simple example. Imagine you invest $100,000 of your own money to buy a property. After collecting rent and paying all expenses, including the mortgage, you have $10,000 in cash left over at the end of the year. Your cash-on-cash return would be 10%, $10,000 divided by $100,000. This simple number makes it easy to compare the performance of different potential investments. It's a key part of risk assessment. A low or negative cash-on-cash return is a major red flag. It signals that the property's income isn't enough to cover its expenses and debt, meaning you might have to pay out of pocket just to keep it afloat. This is a critical risk to assess before you buy. So, to put it simply, while other metrics like the cap rate show a property's potential return without debt, the cash-on-cash return gives you a clear, personal picture of how your invested money is performing once financing is included. It's a fundamental calculation for any investor looking to build a successful portfolio using debt. Have more questions or ready to discuss an opportunity?
Visit the AD Commercial Group contact form at www.adcommercialgroup.com to connect with us today.